For answers, we begin with R.N. Elliot, who pioneered this research in the 1930s and 1940s.
R.N. Elliot was a corporate accountant who specialized in financial restructuring. He was taken ill later in life, and during his recovery, took an interest in the stock market and began a detailed investigation.
Elliot identified an overall pattern to fundamental market movement. The pattern occurs over and over again in the markets. Soon he realized that if you can identify where you are in the pattern, then you can predict where prices are likely to go next. The basic pattern unfolds in 5 waves. The 3 waves in the direction of the main trend are labeled 1, 3, and 5, which are separated by 2 interruptions labeled 2 and 4. The essential form, then, is 5 waves of net movement in the direction of the one larger trend, followed by 3 waves of net movement against it, progressing in 3 steps forward, 2 steps back. Elliot further observed that these patterns were the same regardless of scale. The smaller versions linked to form larger ones, and so on. Bob Proctor became involved with Elliot's wave principle in the 1970s.
I'd been investigating methods of market analysis for quite some time. I got curious about this obscure idea called the wave principle. I wanted to know if some guy had imposed his idea of a pattern onto the market, or was it really there? I started keeping my own hourly charts, and I was quite amazed to find that he indeed explained the patterns that were there. I saw them over and over again, every hour, every day, every week, every month. So I had to know more. And first thing I did was I contacted the Library of Congress, and they didn't have his works, but I finally found them on microfilm in the New York Public Library. So I had copies made, and I found a wealth of material, a complete, all-encompassing theory of the stock market that had been lost to academia and Wall Street practitioners for all those years.
Proctor became so intrigued by the wave principle that he soon republished Elliot's original books in a volume called R.N. Elliot's Masterworks. In the meantime, he contacted financier A.J. Frost.
Frost had been a colleague of Hamilton Bolton's, who, along with a very well-known financial analyst named Charles Collins, kept Elliot's theories alive throughout the 1950s and 60s. And Frost and I just hit it off great from the first minute, and we decided to get together, consolidate all of Elliot's ideas, and put them into one volume.
The book Elliot Wave Principle would become the definitive guide to discerning the market's forms. Elliot Wave Principle has sold over 100,000 copies and has been translated into a dozen languages.
We've had now too high an inflation rate for the last 10 years.
In 1978, as inflation accelerated and after the Dow fell to 780, there was widespread pessimism. Elliot Wave Principle made a bold forecast for the financial future. This chart shows the Dow up to 1978. This chart shows Frost and Proctor's forecast. They expected a great bull market into the 1980s. The forecast came true. The bull market charged ahead further than Frost and Proctor expected, but the advance stayed true to form. It was one of the most highly emotional times in U.S. history, and the stock market was shut down. The night of the tragedy, Proctor released a chart forecasting the S&P Composite Index.
Well, remember that in September 2001, the S&P had already been falling for a year and a half. So by 9/11, it was just days away from finishing 5 waves down, which means it was days away from the start of a very big rally. And that's exactly what happened. Terrorism threw almost everyone off, but it had absolutely nothing to do with our outlook. I mean, there was no terrorism at the high in 2000. It was almost all good news, and that's when you were supposed to be selling. So, sure, waves can throw you off now and then, but if you try to follow the news, it will almost always make you do the wrong thing. The wave principle can also be used to forecast macroeconomic changes. To investigate this, I went back to the charts and I compared changes in social mood against the occurrence of economic expansions and recessions. And what I found was that changes in the economy do not precede and cause changes in social mood, which is what most people think. But in fact, it was the opposite. The social mood changes preceded changes in the economy.
As it turns out, the mathematics behind nature's most vibrant forms play an important role in the wave principle and socionomics. What Elliot described decades ago today are called fractals, which are irregularly shaped objects that are self-similar at different scales. This self-similarity reveals order in many natural objects that at first glance seem random.
What R.N. Elliot discovered 40 years ahead of modern mathematicians is that the stock market is a fractal. Not only that, he said it's a specific fractal. That's one heck of an achievement for somebody without a computer.
The invention of the silicon chip in the 1970s created a revolution in computers and communication.